Bond yields soar to a two-year high. India's benchmark yield jumped to the highest in 2 years on Monday in the backdrop of rising US Treasury yields, continuous supply of state development loans and government securities, and the inflationary impact of rising crude oil prices. The yield on the 10-year benchmark, GS surged about 5 basis points on Monday, to close at 6.59%, and its price declined about 32 paise, to close at 96.58 Indian rupees. Bond yield and price are inversely correlated and move in opposite directions. The yield of the 10-year benchmark paper soared about 14 basis points, and its price dropped about 93 paise vis-a-vis December end closing level. Rising yields in the secondary market has implications for borrowings by the center and states, as fresh borrowings will come at a higher cost. Referring to the Reserve Bank of India's announcement that the government will borrow 13,000 Indian rupees crore via a new 10-year paper on January 14, Lakshmi Iyer, CIO at Head Products, Kotak Mahindra Asset Management Company, said, "So, tomorrow, I think, some short covering will be there. The market will rebound a little bit, but otherwise, the market is worried about supply. There is continuous supply of state loans and GSEC. There is no demand. US 10-year has gone past 1.8%. This is proving to be a dampener." Lakshmi Iyer observed that though the new 10-year has been announced, that is a small respite. "We do also have a state loan auction tomorrow, which is another negative. Plus, the RBI has been doing OMO sales. So, all these are negative factors. Right now the sentiment is not very positive for bond yields," she said. Lakshmi Iyer estimated that the cutoff yield of the new GS 2032 at the Friday weekly auction could be 5 to 7 basis points lower than the prevailing secondary market yield of the extant 10-year benchmark GSEC yield of another widely traded paper, 6.67% GS 2035, has risen about 16 basis points, with its price dropping 1.40 Indian rupees since December end. The latest financial stability report of the RBI underscored that the quarterly weighted average cost of incremental government borrowing has inched up, in line with market benchmark yield movement. The report cautioned that the center's repayment obligations indicate a significant uptrend going forward, implying that gross borrowings are likely to remain elevated notwithstanding fiscal consolidation. Radhika Rao, senior economist, DBS, in a recent report, observed that an unfavorable global environment coupled with caution over a heavy fiscal borrowing pipeline, liquidity withdrawal, rise in oil prices, and lack of direct support from the central bank have driven 10-year GSEC yields to near 20-month highs, past 6.5%. Apart from the center's borrowings, states are also set to borrow a high 3.24 lakh crore in 4Q FY22. While we foresee limited room on the downside, some form of support via secondary market bond purchases might be forthcoming given the sharp one-sided rally in yields, which will help cap a further near-term increase, she said.